Today, we are breaking down the latest earnings report from Peakstone Realty Trust. Now, on the surface, this quarter looked like an absolute disaster, but the stock soared. So we're going to figure out exactly why, because this is a really fascinating story of a company reinventing itself right before our eyes. Okay, let's just jump right into the big question, right? How does a company miss earnings this badly and see its stock rally almost 8%? It's a classic case of the market looking past the messy headlines to see what's really going on under the hood. So first, let's set the stage. We need to look at those headline numbers that caused all that initial confusion when the report first hit the wire.
And yeah, they were not pretty. I mean, look at this. Peakstone missed analyst expectations pretty much everywhere you look. GAAP earnings per share, a staggering 84% miss. Core funds from operations, that's a really key metric for a REIT's cash flow, missed by 13%. And to top it all off, revenue from their main business came in almost 50% below what Wall Street was expecting. Ouch.
But here's the twist. The very next day, the stock just surged, up almost 8%. And that wasn't on some tiny volume either. It was huge. That's not just random noise. That's a signal that the big institutional investors, the smart money, they heard the full story on the earnings call and they started buying with conviction. So what on earth did the market see that wasn't in those headline numbers? Well, it saw a company that is rapidly and successfully transforming its entire business model, basically shedding its old skin and embracing a really high-growth future. The CEO, Michael Escalante, he made the mission crystal clear on the call. The message was super simple. Peakstone is getting out of the struggling office building market, and it's becoming a pure-play industrial landlord. Their new focus is this really hot niche called Industrial Outdoor Storage, or IOS. Just think of it as mission-critical parking and storage lots for things like trucking fleets, construction equipment, and rental cars. And this chart right here, it shows you just how fast they're moving. After the quarter ended, industrial properties now generate over 60% of the company's total rent. They've already crossed that critical milestone. The transformation isn't just a plan, it's happening right now, and it's happening fast. So how are they doing it? They're running a simple but incredibly powerful three-step playbook. Step 1. Aggressively sell off all those old, unwanted office buildings. Step 2. Take that cash and immediately pay down a ton of debt. And Step 3. Reinvest what's left into their new core focus, those high-demand industrial assets. Now, this number right here, this is the proof in the pudding that the strategy is working. When it came time to renew leases on their new industrial properties, they achieved a jaw-dropping 116% cash re-leasing spread. Let that sink in for a second. That means when an old lease expired, they were able to sign a new one for more than double the rent. That is absolutely incredible pricing power. Okay, so the next piece of this puzzle that investors just loved was the balance sheet cleanup. You know, a new portfolio is great, but it has to be built on a rock-solid financial foundation. And they are delivering. With the cash from all those asset sales, management confirmed they've wiped out about $450 million in total debt just this year. That is a massive cleanup operation, and it makes the entire company a much, much safer investment. This brought their key leverage ratio way down, from a kind of risky level of over 7 times earnings to just 5.4 times. Now, the really crucial part here is that their own long-term target for a healthy balance sheet is 6 times. They're already below that target. That gives them a ton of financial flexibility to make moves going forward. And believe me, they are not done yet. Management laid out a super clear roadmap. They expect to generate another $300 to $350 million from selling off the last of their office buildings. And they're going to use the vast majority of that cash for, you guessed it, even more debt reduction. So let's bring it all together. The crucial point is that the market looked right past this messy, noisy transitional quarter. It just totally ignored the temporary dip in earnings and started pricing in the stronger, more focused, higher growth company that Peakstone is becoming. And the proof is right here in the stock chart. While the broader REIT sector has been basically flat all year, Peakstone's stock is up over 25%. So this wasn't just a one-day pop after earnings. Investors have been buying into this transformation story all year long. So the key takeaway here is pretty simple. The market is placing its bets on the quality of the future company, not the temporary messiness from selling off the old one. It's a classic case of valuing the destination, not the journey. So, what's our take on all this? Let's get to the next call, where we break down what this means for the stock going forward.
Well, based on the absolutely flawless execution we've seen so far and the very clear path ahead, we believe Peakstone is going to continue to outperform the broader market. The strategy is working, and the results are really becoming undeniable.
Our outperform thesis is built on a few key pillars. 1. The hardest part is over. Getting rid of those office buildings is almost done. 2. What's left is a pure-play growth story in a sector with huge demand. 3. Their balance sheet is becoming a fortress, which gives them a ton of financial firepower. And finally, all of this leads to a valuation re-rating. Basically, the market will stop seeing them as a messy hybrid and start valuing them like the premium industrial company they're becoming. And we're not alone. Wall Street analysts, like Truist, are reiterating their buy ratings.
So the key question for the next call really becomes about capital allocation. Once the last office building is sold and the debt is paid down, what's the next move? Do they step on the gas and acquire those IOS properties even faster? Or do they start returning more of that growing cash flow to us, the shareholders, with a nice dividend increase? That is going to be the next chapter in the Peakstone story. Just a reminder, this explainer is for informational purposes only. This is not financial advice.